Hello, ladies and gentlemen, and welcome to the FXCM Google Plus Trading Room. My name is Jeremy Wagner, the head trading instructor at Daily FX, and I want to welcome each and every one of you here today to this webinar, which is going to be on basic Forex breakout strategies. And so with the sequestration that may be going on tomorrow of the budget here in the United States, we could have some market volatility over the next several weeks. And so this webinar is quite timely, I believe, and we will get going here in just a few moments. Now, before we move any further, I do need to make sure that we take care of this risk disclaimer. So we'll give you a moment to read this, and then we will get started with the webinar in about 30 seconds. What this risk disclaimer shares with you is what I'm about to show you is no guarantee that you will have winning trades. What I'm about to show you is no guarantee that you will be kept away from losing trades, and therefore it's important that you trade with risk-based capital. Risk-based capital is money which you can afford to lose. Also, since this webinar is meant to be educational in nature, of course, we're giving this webinar without specific regard to your objective or financial situation. So therefore, make sure that you view this webinar from an educational perspective. It's meant to help you become a better trader. Okay, so let me go ahead and remove this risk disclaimer, and let's go ahead and get started. Again, my name is Jeremy Wagner of the Daily FX Education team, and we're going to get going here on this basic Forex strategies or basic breakout strategies for Forex trading. And there's a couple other house cleaning items I need to take care of. So let me go ahead and share my screen with you real quick. Just a moment. Okay, there you go. Right now you should be able to see the FXCM Google Plus page, and there's three things that I want to be going over here from a house cleaning perspective, and then we will get into the charts, talk about breakouts and these basic breakout strategies. And actually, that is not the right screen that I wanted to share with you. Let me try this again. There we go. Let's try this again. Okay, here we go. You should be able to see the FXCM Google Plus page, and there's three things that I'm going to show you here. The first one is we do several live webinars, and we are going to start doing some webinars at this very location. So as we go along, if you find that you like the webinar that you're seeing here, we just simply invite you to go ahead and give us a +1. For those that are familiar with Facebook, that is like saying, I like this comment or I like this post. Giving a +1 is like giving your thumbs up to the webinar, to FXCM, and to the content that we are providing you. So I'm going to go ahead and press +1 to illustrate this for you. The second thing I want to go over as well is, since we do several webinars at this location, we have a few planned out over the next several weeks. One way that you can keep in touch with us is to follow FXCM and make us a part of your Forex circle. So simply what you do is you see a follow button, and this is when you're logged inside of your Google Plus account, and then you just simply come down here. Now I've already got a Forex circle created. Now if you just logged into Google Plus for the first time, you're just simply going to see friends, family, and acquaintances, maybe have other types of circles out there. So you might need to create a Forex circle. And to do so, you would just simply left click where it says create new circle, type in Forex, And in this case, I've already got a Forex circle out there because I have both daily FX and FXCM, now FXCM, in my circle. And so I got Forex circle, and it's showing 2 of them out there. So what the benefit to you of including us within your Forex circle is that as we do future webinars, you will automatically receive an email when we get these webinars scheduled. So you don't have to stay tuned to the computer or watch us via Twitter to find out what's coming up within our Google Plus Hangouts and future broadcasts that we plan on doing. Now lastly, one last important item: if you're wanting to chat with me throughout the course of this webinar, you will need to be logged into your Google Plus account. Now if you don't have one, hey, no worries, there's no charge for it. But if you are wanting to make comments or post any comments into the chat box, what you're going to need to do is sign into your Google Plus account. It's free, and then that will allow you to comment to the room. And if you don't want to do so, that's fine. You could just simply watch the video. Okay, so let me get this off of the screen, and let's go ahead and get started and dig right into the charts. Just a moment. There we go. Sorry about that, ladies and gentlemen. User error on my part. So here we go. You should be able to see my screen now, which is currently located on the pound CAD currency cross rather. And what we're going to be talking about in this webinar: basic Forex breakout strategies. First of all, I want to talk about what is a breakout. We're going to take a look at conventional thinking when it comes to trading, and then what a breakout strategy is going to do. We're going to show why it works, and we're going to use the price of silver to help illustrate that for us. And then what types of breakouts that we can implement, and what types of market conditions that we need to see when we are looking for breakout trades. And then we will dig into specific charts and identify some potential breakout opportunities on the horizon. So let me start off here with what conventional thinking is. So conventional thinking, you've heard it probably all throughout your trading career, even before you became a trader, maybe when you were a teenager or a young boy or girl. You may have heard the old mantra of buy low and sell high. And so the conventional thinking is that we identify a level of support, and you come down here, and that's where you look to buy. So when the prices move higher and reaches resistance, then at that point, that's where you look to sell. It's a buy low, sell high type of mentality. Well, breakout style of trading, believe it or not, is the exact opposite of the conventional style of thinking. In a breakout style of trading, we're not looking to buy at support. We are looking to sell at support. Okay, so here I've drawn 2 black lines here. The upper black line represents resistance. The lower black line represents support. And in a breakout style of trading, we're looking to sell below support, and we're looking to buy above resistance. So it is the exact opposite of buy low, sell high. In essence, we are wanting to buy high and then sell even higher. That's the way that the strategy works, generally speaking. And you may be wondering, well, why in the world would somebody want to do that? That seems ridiculous. How could it possibly work? And the reason that it could work is because the financial markets operate a little bit in a different environment than what you may see for other commodities. So to illustrate this, I want to take a look at the price of silver, okay? Now, I've got 3 kids at home. They're young kids. They like to eat cereal for breakfast. Of course, they like to drown their cereal in milk. It seems like we go through a gallon of milk every other day. So let me first start off with purchasing milk at the grocery store. Now, a gallon of milk may cost about $2.75 right now. And when we go to the grocery store, if that gallon of milk all of a sudden seems to cost, oh, let's say $2, then, or maybe even $1.50, well, at that point, we could buy 2 gallons of milk for the same price that we could buy 1 gallon of milk previously. And then my wife and I get excited because we drink the milk, so we go ahead and we buy more milk at the cheaper price. So as we buy more at the cheaper price, well, then eventually, you know, prices will move higher because you have more buyers at that lower price level. And there are similar dynamics in the financial markets, but there's one pivot to it. And that is, in the financial markets, because there is emotion attached to these trades, we have our money on the line, our hard-earned money on the line, that when we see strong trends taking place, sometimes we're like a bug drawn towards light, and we are just simply afraid of missing out on those strong trends. Afraid to miss out is a very strong emotion. We may bring rational, logical thinking into our strategy. And so, for example here, on the price of silver, we could see that the price of silver has been in a very nice uptrend. We've analyzed this trend, and this is in 2010. And we're like, you know, I like this trend. This is the type of trend that I think is going to be a long bull market. I want to buy silver. But you know what? I don't want to buy it at the current levels here where this red candle is. I don't want to buy it at the 2760 mark. I want to buy it at a little bit lower. I want to buy it down here around 25, down where prices previously found some support. Okay, so I've developed my trading idea and my trading plan. And then I'm going to illustrate how breakouts can work and how emotions, how we bring our emotions into these trades, and it causes us to do what seems to be irrational things. So it's 2010. The economy, is just pulled out of the doldrums of 2009. Silver is considered an industrial metal. So if the economy is doing better, then there tends to be more demand for silver. The dollar also tends to get weaker, which would help the price of silver move higher potentially. And so we wait. We have our idea. We wait for prices to come down to about the 25 mark, and then we look to buy. So let's fast forward this a little bit. Well, price gets close. Price gets down to 26.40, but it never does quite make it to our 25. And then we see price continue to move higher. Price is now up to 32. All of a sudden, we're getting nervous, and we're starting to kick ourselves in that, doggone it, I knew that silver was in a nice, strong trend. I knew it was going to move higher, and we continue to watch the price of silver move higher, and then finally, we're like, you know what? I can't wait anymore. And so we throw caution to the wind, and we go ahead and we start buying silver. Even though we wanted to buy it down here at 25, because we believed that this was going to be a strong trend, and now we're seeing this strong trend playing out, and we're missing out on it, we throw caution to the wind, our emotions take over, and then we just start buying into this strong trend. Okay? And so this is the backdrop behind how a breakout strategy works. Because at the same point, had we just said, you know what, I'm going to play a breakout type of trade so that if prices move up above this high around $31, once prices move up above that high, I'm going to get entered into this trade. And so I just simply put a buy stop order to enter at $31. And then sure enough, silver does take off to the upside because I'm playing on this emotion of the traders who thought silver was going to be in a strong trend, but who were waiting for lower prices to buy. And I'm playing on the emotion of those traders who are just getting in because they're afraid to miss out of a big trend. And sure enough, this was a monster of a trend that went all the way up to $50. So that's how breakouts can work. Now, there's a couple of different ways that we can look for breakout type of trades. One way is that we could use trend lines. So for example, coming back here on silver, I think that the price is in an uptrend. I could just simply draw a trend line. And I could say, you know what? I want to buy at 25, but if price breaks this trend line, I may look to buy on a break of this trend line. And so that would have put us in at a much more favorable price at around $28 than waiting to get in after our emotions take over around 30, $32. The other way that we could trade this could be based off of horizontal levels of support or resistance. In this case, we could look for horizontal levels of resistance, which would be a former swing high. In this case, the former high of January the 3rd, 2011, we place our entry order to buy just up above that level. Okay, so that's in essence how we can look for breakouts. Two different ways of entering it. There are pros and cons to each. You know, the benefit of trading on a breakout of the black line is that you're getting entered into the trade sooner at a much more favorable price. The downside to entering at the black line is that it could be a fake out trade, it could be a fake breakout, false breakout, and then prices end up trucking to the downside. The benefit of using the higher level at the purple dotted line, the benefit of using that as our entry is that once prices break up above this level, it's the market indicating to us that the market is ready to trade at levels it hasn't seen, which in this time probably about 25 to 30 years. That's a strong trend. So you let the market do the heavy lifting for you. You let the market dictate to you when it's ready to trade at levels it hasn't seen in quite some time. Okay, that's the benefit of using the purple line. The downside of using the purple line is, well, yeah, we had this great idea of buying silver when silver was around $28, and now we're waiting to buy unless it pushes higher. But again, that benefit is we get paid to wait, because if prices never make it up there, we never get entered into that losing trade. Once prices do make it up there, that's like the market flexing its strong muscle and saying, hey, I'm in a strong trend. This is a trend we need to trade. And I'm talking about back in that 2010, 2011 area. Right now, I'm not so sure that's the case. So that's the backbone of the Forex trading strategies. There's two more important elements that we need to consider when we're looking for breakout trades, because after all, we could come out here, we could take a look at this euro dollar, we could pull up any time frame of chart, and we could see, all right, yeah, I see some potential breakout trades, a breakout above this high or a break down below this low. I mean, you can start finding breakouts left and right. However, there's two things that we need to consider when we're considering what market to trade. This is a very important question that many traders often overlook, and sometimes this one ingredient could be the key to you trading more profitable pips in your account, to you losing pips in your account. It isn't the same for everybody, but for a lot of folks, this is the one missing ingredient, is that they have a strategy. They have their set of buy and sell rules, but they don't really have written into their plan how to determine which market to apply that set of buy and sell rules to. And so on a breakout style of trading, if we're like, hey, I'm gonna trade breakouts, well, if you're gonna do this, you got to include these two important ingredients. And you only need one of them. And that is you need market volatility. Market volatility tends to work more favorably towards breakouts. Or you need strong trends in the market. If you have strong trends and or market volatility, then the chance of your breakout trades working out are improved. So that's how we can take a breakout style of trading and make it into a high probability breakout style of trading. Okay, so here's the euro dollar. Why don't we just go ahead and talk about this? We'll talk about a couple of currency pairs. And, you know, again, there's two different styles to trade breakouts. We could trade breakouts on a trend line break. So here I have this upward sloping black support line. And once prices broke this upward sloping black support line, we could use that as our signal to go ahead and enter short. Now, for those that were watching my webinars around this time, this would have been about 2 weeks ago. At that time, I was saying, hey, I'm not buying into this break on euro dollar to the downside. I think we're going to have a move back to the upside, and that might actually be a buying opportunity. Well, I was right for maybe a couple of days, and then the market proved me wrong and ended up doing a more forcible break to the downside of that black line. So trend line is one way that we could play breakouts. The other one is horizontal levels of support or resistance. In this case, I have horizontal support down here near the 130 mark. Not only is it the swing low from back in early January 2013, but it's also round number support. 130.00 is a round number, and that often can act like support and resistance as well. So remember, in a breakout style of trading, we would look to sell at support or sell a break below this lower purple dotted line, which is around the 130 mark. Now, for those that are aggressively looking to sell the euro dollar, you might be right, but keep in mind, euro dollar hasn't quite broken below this low right here. So this trend on the euro dollar, although it is close to being over, it's got about 9 toes in the grave right now. I'm talking about the uptrend. But there still is a chance that this trend could re-exert itself back to the upside, because if I were to extend out these black channels, we would find that we are still inside of these black channels. Okay, and so there still is a chance that prices could break out up above this channel and move on to higher highs. So that's euro dollar. I'm going to share with you some trend lines and some potential breaks, and then we'll look at an indicator that you can add to your chart to help you identify breaks of support and resistance as well. So let me start off with the dollar yen, one of the beloved yens. This thing has been a monster trend for the last 2 or 3 months with what's going on over in Japan and looking to add inflation to their deflationary economy. They vowed to weaken this yen to try to help their imports with a weaker currency. That is, if Japan had a weaker yen, then that would make their goods that they purchase on an apples-to-apples basis look less expensive than a competitor in another country. So they have a very much of a vested interest, because they're an export-based economy. Japan has a vested interest in wanting to maintain a weak currency. And so the new Prime Minister Shinzo Abe has come out and says, hey, I'm going to do whatever I can to help create inflation. And the downside of having inflation created is that means that the interest rates that they would be paying for stuff would go up. And for an economy that's aging, and you start taking bonds and having higher interest rates, well, that means the value of those bonds are going to decrease. So, there are some negative ramifications for creating inflation in a very much of an aging economy. So taking a look here at the dollar yen, I've got a support line going from the lows of mid-November 2012, connecting common lows, and then that sell-off we saw on Monday, ladies and gentlemen, that sell-off we saw on Monday, it came down and it simply tested this line. It's bounced off of it a couple of times. So this is an important line that the dollar yen has found. So there's a couple of things we could do here. If you think the dollar yen is going to continue moving higher from current levels, well, you could use this line as a means to buy. However, if you think because we've come down and poked on this line three times to be exact, the more times the line gets touched, the weaker it becomes. And it's like waves crashing up against the sandy beach. If you built a sandcastle on the beach, as the waves crash up against it, the first wave might not knock over the sandcastle. It's the second, it's the third, it's the 10th wave that crashes against the sandcastle that eventually tears it down. That's the same thing with trend lines. The more they get touched, the weaker they become. And that's because more people start to notice them, and the market is going to try to fool the most amount of people most of the time. So anyway, we could simply look for a breakout below this line. So our line is currently around the 91.50 level. We could just simply look for a break below this line and use that to enter in a trade if you think that the dollar yen is going to continue lower. As for me, I'm not quite sure what the dollar yen is going to do around these levels, but a break lower is probably going to see some type of a reaction to the downside. I think the stock market here is acting like it's going to want to keel over within the next couple of days. We saw that strong sell-off on Monday, and we bounced back. At least the Dow Jones has bounced back to create a higher high, but the other stock markets haven't quite. So that's a bear signal, and so if we get stock market selling off, this dollar yen may sell off as well. Let's go over and let's check out the pound. A lot of people have been interested in the pound, and what I've drawn on this chart, very strong move to the downside. One of the weakest currencies. The pound has been battling the yen as one of the weakest currencies over the last couple of months. And so here we're taking a look at a 4-hour chart. And if I just simply draw the support line and duplicate the line, so I've got my black support line. If I duplicate it, guess what? It fits perfectly right within inside this range. And so using a breakout style of trading, we could just simply look for prices to break below this lower black line, which is currently around the 150.80 level. And that would be our clue, or that would be our signal to go ahead and enter into this trade.
Okay, so
and then as far as the stop loss goes, this is a 4-hour chart, so you could place a stop loss just up above this swing high, so that would be around the 52.20 mark, maybe about 140 pips of stop loss. So that could be one potential way of placing this. Or once we get that break below the 50.80 mark, we could dial down to a smaller time frame chart, perhaps a 1-hour chart, and we just simply measure up where our recent swing high is upon that break and use that swing high as a means of placing our stop loss. And then on breakout style of trading, for a breakout style of trading, you can use a take profit level. And what I would suggest is whatever the distance is to your stop loss, you look for twice that as your take profit level. Or you could use an open-ended take profit level, meaning you just simply manually, sorry here, I got alerts popping up on my screen, simply meaning you manually trail your stop, and so that way if the market moves in your favor, you're manually moving and stop in your favor so that you're locking in trades.
that'd be pretty cool to take $3 million.
All right, so let me go ahead and grab some questions here. Just a moment, and then we will take a look at a few more charts. So we got a question here that says, how do we prevent from being caught in false breakouts? And that's a good question. And this gets back to what I was stating earlier, in that there's a couple different ways you can enter trades, but there are a couple of ingredients that many traders overlook. And many times, these ingredients, when you mix them into your recipe of a trading plan, these ingredients can make a big difference on your account. Again, let me review those ingredients. When you're looking to trade breakouts, obviously you want to try to prevent false breakouts as much as possible. And so one way to prevent false breakouts is to trade breakouts in a high volatile environment. Okay, if the market is being volatile, that means support and resistance levels are less likely to hold. Because in volatile markets, if we just sit back and if we think for a moment, what exactly a volatile market means. A volatile market just simply means prices are not comfortable at their current levels. And so when you get some volatility, like for example, we've got the sequestration deadline coming up tomorrow. And perhaps that was part of the onus behind Monday's sell-off. Italian elections may have had something to do with that as well. But the point being is there was uncertainty in the markets. Markets don't like uncertainty. And with that uncertainty, you have people that are emotionally saying buy. You have people who are emotionally saying sell, and it creates a lot of whipsaws and a lot of market volatility. Take, on the other hand, a range-bound type market environment. In a range-bound type market environment, prices are very comfortable at trading at those levels. There's less uncertainty, and so prices are very comfortable. So in a breakout style of trading, remember, we're looking to sell at support. So therefore, if we have volatile market conditions, support and resistance levels are less likely to hold, and so therefore our breakout strategy is more likely to follow through in volatile environments. The euro yen was a great example of that on Monday. Had you traded some type of a breakout on the euro yen to the downside, even if it was about a 650 pip move from top to bottom, even if you missed the first 300 pips, there was still a couple hundred pips to the downside on a simple breakout. So once that broke, it followed through, and that's because the markets were quite volatile on Monday. The other element, the other ingredient we want to add to this trading plan to help prevent these false breakouts are going to be strong trends. If we identify a strong trend and trade in the direction of that strong trend, then that will help bail us out of false entries as well. Okay, that's a very good question, so thank you very much for asking. Let's go ahead and get it back on the charts here. And we got a comment here from Craig. Excellent presentation. I'm thoroughly jazzed by FXCM and the wealth of knowledge and help available. Thank you very much, Craig, for joining us here today. We appreciate your kind words. And yeah, this is just the tip of the iceberg. I'm just one of several people that we have on board to help teach you about trading and how to trade the Forex market. So make sure you stay tuned. Make sure you include us within your Google Plus circle. That way you can be alerted of any future events that come up. So remember, once you log into your Google Plus account, let me share my screen on that real quick. Okay, once you log into your Google Plus account, at the top you'll see something that says circle, and make sure you add or create a Forex circle and include this page where you're watching the webinar from. Include that in the Forex circle, and then that way you will be alerted of future events that come out and take place. All right, let me go back to the charts here. Okay. Oh, one other thing I want to go over with regards to trendline breaks, and then we'll take a look at some ways that can help you identify breakouts. Maybe you're new to Forex, you haven't traded breakouts quite a bit, and here, this is the dollar CAD, and I haven't tweeted this out a whole lot, but I have certainly been watching it. And the Canadian dollar has been incredibly weak. This is an interesting pair that has been on my mind, but I'll admit I've been a little foiled on exactly how to trade it. But nonetheless, if we go back to 2011 and take a look at this downward sloping resistance line, there's touch number one, touch number two, I draw my resistance line. Well, prices broke up above this late last week. And one of the things, when you're just looking at trend lines and you see, oh my goodness, I missed this trend line break, well, many times what was resistance, prices may come back and it may act like support in the future. So notice that when prices broke above this black resistance line, eventually prices returned and it bounced off of it because this black resistance line became new support. And boom, we're pushing higher. So one way that you could trade the dollar CAD, if you think that the volatility that we're going to experience tomorrow is going to be negative for the economy, one thing that you could do is you could look to buy the dollar CAD. And it's broken out, it's bounced off support. This is a very technically clean pattern to the upside. You could just simply look for a break up above today's high, and you could use that as your entry. Place your stop loss just below this recent swing low. So that could be certainly one pair to watch out for. I got a question here, what's the best pair to trade for possible breakout? The dollar CAD would certainly be one of them. Also, the Japanese yen, I mentioned that a few moments ago. Maybe not so much the dollar yen, but maybe a currency pair like the euro yen might offer it, might offer up an opportunity to trade. I like the Australian Japanese yen cross pair. The reason being is that the Australian Japanese yen tends to have a correlation to the stock market. So if you think it's going to be a negative volatility that comes as a result of the sequestration, and the stock markets may sell off. Well, if you take a look at the Aussie yen historically has a correlation to the movements in the U.S. stock markets. And I wrote about this a couple of weeks ago, actually it's probably about a month ago, and that stocks were near resistance, but until we broke below this upward sloping black line, we cannot say for sure that the high is in place. Well, we did finally break below this upward sloping trend line. We put in some lower highs. It looks like we're getting ready to put in some lower lows. So the Aussie yen looks like it may be ready to roll over. This could be giving us a clue about what may be happening over the next several weeks as a result of the sequestration. As a matter of fact, the sequestration, is I think a lot of people are going to wake up tomorrow morning and be disappointed. Be disappointed in that they're expecting something to happen. I think there's a high probability nothing's going to happen tomorrow except for the sun's still going to come up and the sun's still going to go down at the end of the day. And we're going to get hungry a couple, 3 times over the course of the day and want to eat. Other than that, I don't think there's going to be a whole lot different tomorrow than any other day. We'll still put the pants on one leg at a time. Because sequestration is simply, and I find this very interesting, almost comical, except the fact that some people will probably lose their jobs as a result of this. So, if it wasn't for that, it would be somewhat comical. But the sequestration, this whole idea, not the idea of sequestration, but how we got to this point was birthed back around April of 2011, if not sooner. But it really started to come to head in April of 2011. It was at that time when everybody in the United States knew that we were going to hit our debt ceiling in late July and early August. It was no surprise whatsoever. And then sure enough, nothing happened between April and late July. And then all of a sudden we get to late July. As we get to late July, then all of a sudden the markets start falling apart. We come up, the Congress comes up with a deal with regards to increasing the debt ceiling at the last minute, the 11th hour, and the markets continue to sell off for about another month or so, and then eventually recovered up to the levels where we're at now. I'm talking about the stock markets. So that all started April 2011. Well, when they increased the debt ceiling in July, August of 2011, one of the things that they said was, all right, look, we can't figure this out. We're smart people, we're congressmen, but we just can't figure this out. And so therefore what we're going to do is we're going to create this super committee. And if the super committee can't figure this out, then we are going to put in some massive cuts that are going to be so onerous that somebody's going to have to do something. Okay, so the whole idea behind the sequestration cuts was that they were going to be so bad that, they were going to have to come up with some type of compromise and come up with some type of deal. Okay? Well, that was a couple of years ago. And our Congress people have done an outstanding job of kicking the can down the road, because here we are almost 2 years later, and they've done almost nothing with regards to it. So 2 years ago, it was these cuts were going to be so onerous that somebody would have to do something. And now it's almost like neither of them want to do anything. It's almost like they're playing a game of chicken with one another, and I'm talking about both sides of the aisle. So that's what I find interesting about the situation, is how 2 years later, we're jawboning that we need to do something about it, but as far as real action that's coming to play, it doesn't seem that it is taking place. But nonetheless, let's get back here to the charts. And let's follow up here with regards to the Aussie yen. It tends to have a correlation to the stock markets. And the Aussie yen's looking weak. The Aussie looks like it could move lower. If we get that break on the US dollar Japanese yen, that could also send this Aussie yen lower as well. Got a break in the line. Maybe it'll come up. Actually, this looks like very good resistance level around 95 that we hit. I just noticed this, okay? Remember on the dollar CAD, how I mentioned what was support acts like new resistance. Well, for the dollar CAD, what was resistance acts like new support. Well, here on the Aussie yen, what was support is acting like new resistance, okay? So that prices were supported there, prices were supported there. Boom, we had our break. And then after our break, we're coming back and we're giving a test to this 95 level on the Aussie yen. So what we could look to do here is we could look to initiate a short trade and look to sell this further. You could do it on a retracement strategy up here near the 95 level. Or what we could do is we could dial down to a smaller time frame chart, let's say like a 1 hour chart. We can add the Donchian channels indicators to our chart. I'm going to use a 55 period input setting, and that's what these horizontal brown lines represent. And so in this case, if price breaks below this lower line, then I'll use that to initiate my sell. So 1 pip below the lower line is where I sell a breakout. And if I'm looking to buy, 1 pip above the upper line is where I would look to buy a breakout. Now right now, the lower line is down here around 93. We're currently up at 93.64. That's 160 pips away. You may be like, that's way too far away. But keep in mind, over time, if price doesn't come down and hit the lower line, over time, this lower line will work its way higher. And so it does require a little bit of patience. But when it comes to the markets, we probably all could use a dose of patience from time to time. So that's Aussie yen. Euro yen, similar type of situation. And, dollar Swiss, I've talked about high probability breakout trading in the past. And so here's the dollar Swiss, okay? This is one back on February the 21st. So this was last Thursday. This was the trade we'd set up where we wanted to sell at the lower channel and we wanted to put our stop loss at the upper channel. Well, this is a great example of how prices never came down and reached my lower channel. So even though prices moved against me, I never got entered into this trade, and therefore I would have never been entered into a losing trade. But notice that as time was on my side, prices never hit my lower channel because I wanted to sell the dollar Swiss. Well, now my entry for the dollar Swiss is at a higher point. It's at a better point. So I would be selling at a higher price level around 92.31 instead of the current level around 91.81. So let me go ahead and adjust these orders. Simply left click and drag to 92.31. That's where my new sell would be. That would be 1 pip below the low. And let me adjust this stop loss up here as well. That's going to be just up to where this brown line is. I know it's probably kind of hard to see. There we go. See if that thickens it up. But my brown line just moved up on this most recent 2-hour candle. And so that's where the stop loss would be placed up there. And if the dollar Swiss continues to move higher, well, then I'll never get entered into this dollar Swiss sell trade, which means even though I was wrong on the idea, I would have been kept away from a losing trade. So, again, what are the best pairs to trade for possible breakouts due to tomorrow's sequestration? I think Euro yen, Aussie yen, dollar Swiss might be a possibility as well. So Euro yen, Aussie yen, if it's good news or bad news, I think the Euro yen and the Aussie yen could help you out in that regard. If we're talking about good news, I think dollar Swiss to the downside on good news would be good. Dollar CAD to the upside if tomorrow's sequestration, ends up being bad as well and doesn't look good. But again, I don't think tomorrow's going to be anything overly exciting. I don't think it's going to be any different than what we've been seeing in the past. In that, it's just cuts to future spending. So they still get to spend at the levels that we spent at last year. This is just saying, hey, you can't spend more next year. Or can't spend as much as you wanted to in your increase. There are still increases in the budget, so we can still spend more next year. So it's not it's just a cut of future spending, a cut of future increases rather, more so than a cut in spending. So I think any negative ramifications coming out of this are probably going to be a bit overblown in the beginning, but it may be like a snowball that builds up over time. The longer that nothing is done, then the more it's going to build up, the more you're going to hear about layoffs, the more people hear about layoffs, the less they're going to want to go out and buy new cars and new televisions. And the less they buy of new cars and new televisions, then more people at Best Buy start getting laid off, or possibly even Walmart. And it begins to become a snowball effect to the downside. And question here from Chad: would you consider the 1 hour Aussie Kiwi cross pair having a break to the upside right now? All right, Chad, let's go ahead and check this out. And Aussie Kiwi. Okay, so we've got the Aussie New Zealand. Now I'm going to use take a look here using the channels. The Danchin channels is what they're called. These are named after a fella, Richard Danchin, and they are famously used by the turtle traders. So if you know anything or have heard of the turtle traders, yes, they used a strategy using the Danchin channels. It's a very simple way of framing the charts and helping us identify levels of support and resistance and entry and potential exit points. So here's the Australian-New Zealand cross pair. Now the first thing that we have to ask ourselves, remember, there's two ingredients that we want to look for. We only need one of them to be present when we're considering trading a market. That is, we want to see volatility in the market, and we want to see something that's in a strong trend. Now we take a look here at the Aussie Kiwi, and this is a daily chart. I would say, I don't know if I'd call this like a mega trend, but for the Australian New Zealand dollar, this is a pretty strong trend. You have two economies that are closely tied to one another, very close geographically. They do a lot of trade with one another. So goes one economy, so goes the other economy. And so, therefore, the Australian New Zealand historically is going to be a range-bound type of currency. But when we take a look at this daily chart, arguably this thing has been in a trend to the downside. This has been in a trend towards Australian weakness in favor of New Zealand strength. Now, New Zealand has been one of the weakest currencies over the last couple of days, so that's why we're seeing this Aussie New Zealand move higher. So with regards to the question, would this be a break to the upside? This could be a break to the upside. If we take a look at our 1 hour Danchin channels, we are still nowhere near the upper buy point of the channels. But if you're looking for a more time-sensitive trade, be looking to buy at higher levels above this 24.35. I would be careful about buying the Aussie New Zealand because our trend has been to the downside. You might get rewarded, you might be correct on the trade, but the trend is clearly to the downside. Why is it important that we trade in the direction of the trend? Because there are more pips to be made in the direction of the trend than there is against the direction of the trend. All right, let me illustrate this for you real quick, since we just have a couple of minutes left. And for that, I'm going to use the pound Aussie as an example because it tends to exaggerate its trends. It has fairly clean trends, so let me go back in time. Okay, if we take a look at the Euro Aussie here, 2009, 2010, this was obviously in a very strong trend to the downside. Now, if you take a look at a chart in a strong trend, and this is why it's important to trade only in the direction of a trend, is you'll notice that if you were that lucky person to sell at the top and buy at the bottom, and if you just simply counted how many pips there were in that particular move, that would have been about 3,600 pips. Okay, and let's say you were that lucky person that bought at the bottom and then sold back at the top. I don't think anybody could do it, but let's just assume that you were that lucky person for the moment. You would have gained about 1,000 pips. And let's say you were that lucky person that sold here at the top and bought it back down here at the bottom. Okay? That would have been about 1,100 pips.
Yeah.
And then let's say you were this lucky person down here. You bought at the bottom and sold at the top. That would be about 1,000 pips. Okay? So we had two iterations. We had 2 sell trades. We had 2 buy trades. Add them up. The sell trades, there are more pips tied up in those sell trades. There were more pips to the downside than there were pips to the upside. So yeah, 1,000 pips is nothing to sneeze at on a buying opportunity for the pound Aussie. But in a trend that's so strong, why would you mess with trying to pick a bottom when the trend is strong to the downside? Why not look for ways to enter in the direction of the trend to the downside? That way you will align yourself in the direction of the trend, which over the past has shown there's more pips in the direction of the trend. Now, you could be that unlucky person that enters that trade at the worst time, right as the market turns. But that's going to happen to all of us. And if you apply this type of methodology, for every time you do something like that, there's going to be several other times where you actually may get rewarded. And so trading is a game of 3 steps forward, 2 steps backwards. It's a marathon, not a sprint. And so therefore, when you do have the losses, you just need to take it on the chin. Make sure you have risked a small amount of your capital. We recommend less than 5%. I like to trade with less than 2% capital at risk. That way, if I'm wrong, there's over 99% of the capital left over in the account. So getting back to that Aussie Kiwi, again, that Aussie Kiwi has been in a strong trend to the downside. Now, it's possible that this could be the beginning of a new move to the upside, but you can clearly see there's more pips to the downside on the Aussie Kiwi than there is to the upside. And this is because the Australian, the RBA, the central bank for Australia, they're aggressively cutting their interest rates. And as they're aggressively cutting their interest rates, money is leaving Australia and looking for higher yield somewhere else. Or if they had invested in Australia years ago because of that higher yield, perhaps maybe they're just taking some profits, pulling some money off of the table. That's why the Aussie's been selling off. And either way, we've got the Aussie, we got the CAD, we got the New Zealand selling off. Commodity currencies, that's what those are called. The commodity currencies are not looking good, and I am shocked and surprised that the price of oil has been able to hold up through all of this. The commodities are screaming recession right now. The commodity currencies, rather, because they are the 3 weaker ones: the Aussie, the Kiwi, and the Canadian dollars. Those are the weaker currencies, and so just based on them alone, it's spelling bad news ahead for the economies of the world, and that there's possibly going to be a recession. All right. Well, I want to thank you all again for joining me here today. It was very much a pleasure having you here, and it was a great webinar. Hope you enjoyed it. Hope you were able to take something away from it as well. Make sure that if you like the webinar, to go ahead and throw a +1 out there, and make sure that you also include us within your circle, your Forex circle of influence. That way, when we do future events like these, you'll be automatically alerted to these future events. And again, thank you all very much for joining me today, and let's keep an eye on these breakouts. I think they're going to offer us some opportunities over the coming days and weeks. But until next time, I want to wish you all the best of luck in your trading. And signing off for today, this is Jeremy Wagner of Daily FX Education, and we'll talk to you soon. Bye now.